The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Come on, everybody, wake up. It's Squawk Box. It's Monday. I should wake up. Karen Cho, myself, Steve Sedgwick. I'll give you some headlines, shall I? Right, let us move on to the headlines. So, EU and Chinese delegates are heading off a trade war, Well, agreeing to hold talks over the bloc's planned tariffs on Chinese electric vehicles.
We have always benefited from an open global market, but we are now entering a new phase where trade protectionism is rising in various forms, which is very concerning to us.
Asian stocks diverging after Wall Street ends the week on a soft note in the longest stretch of low volatility since the financial crisis.
French President Emmanuel Macron's centrist bloc slips further behind in the polls, trailing his far-right rivals as campaigning enters its final week before the high-stakes first round. Former US President Donald Trump hits the campaign trail while Biden bunkers down, prepping ahead of the first presidential debate this week.
Good morning, how are you? I was doing so well until I rechristened the show Squawk Box.
It's been called that before.
It's not South African, it's not Squawk Box, it's Squawk Box. We're all encompassing.
Plenty of spring in our step, though.
Did you have a good weekend?
I did, thank you.
Did you get up to lots?
I didn't do what half of the UK was doing, and that was going to the Taylor Swift concert, right?
Oh, that's half of CNBC, I think you'll find out.
Representative
the other
of the
half
country.
were just getting burnt, because we're good at getting burnt in the UK, because we don't
Yeah.
see the sun for 363 days a year. So on the 2 or 3 days we do, we just go out there and we forget to put on factor 50.
We did turn up the dial a bit, didn't we, on the temperature?
Yeah.
It was
you
lovely in
used to
parts.
that, so it's
I
fine.
didn't think it was overly hot for me.
Wasn't no.
It was average, you know.
There's a lot going on. And I don't know how much I hold faith in these China and EU talks, I've got to be honest.
Yeah, I mean, we seem to be having a better relationship that's been unfolding between the West and China in the last number of months. But it feels as though that might be about to come to an end. We've got this presidential debate happening later on this week, and we know that Trump's going to go after China. Biden's already been very tough on China, so that's going to heat up again. But now these tariffs that the EU is pushing ahead on EVs, it seems to have very much irritated the Chinese. So I do wonder whether this slightly warmer relationship we've seen is about to turn in the opposite direction.
I think the words of warmth are on the surface, but I think when it comes down to it, the US and Europe are worried about China. They're worried about what the relationship looks like longer term. There is no doubt, and as I've tried to explain to the viewers many times over the years, despite the political frostiness, which is growing, I think, between Brussels and European nations and the Chinese, and Washington and the Chinese, I think it's getting frosty. The fact is, the trade flows between China and the West are still absolutely enormous. The synthesis between the two blocks, or the three blocks, is huge as well. So businesses have just got on with business. But I think now, obviously with the reshoring trend, obviously with the diversifying your supply chain trend as well, China has to find a way to combat its own economic problems as well. And it's looking at flooding the West with high-end EVs, solar panels, you name it as well, chips, what have you. But the fact of the matter is, the West is responding.
Well, this is exactly what Europe doesn't want. We've just gone through the last number of years looking at supply chains where there's been a dominance of product coming through from China, and there's been a move to correct that. So as we talk about future industries, why restart or reset the clock for the future of products that we're going to be relying on and have a huge dominance of Chinese products in the supply chain? So again, this pushback is starting to happen from the European side. It has been one that's gone on for many months. So I think the fact that it's so nuanced too on certain companies that cooperated with the investigation where there hasn't been necessarily oversupply, there's a different grade on the tariff, but still the Chinese are objecting.
And look how hopeless the European energy policy was. Hopeless, relying on one adversary, one supplier, and now, you know, the Germans and everyone realise that you just can't rely on them for your gas, can you? Anyway, China and the European Union will hold talks over the EU's decision to impose tariffs on Chinese electric vehicles. It's the first time the two sides have agreed to enter negotiations. Hang on a second, are these negotiations? That's what I want to know. Talks about where we're at, but are they negotiations? since an EU probe into Chinese EVs led to the decision to increase tariffs on some vehicles to as much as 48%. It comes as German Economy Minister Robert Habeck visited Beijing, the first senior EU politician to make the trip since the tariffs were proposed. Habeck said he welcomed the move by China, but that it is just a first step of many. Speaking in Beijing, Habeck warned of the economic impact of tariffs.
We are seeing increasing tariffs, local production requirements, and financing restrictions. These measures will raise product prices, reducing consumer purchasing power, and hinder investment and innovation. We urgently need investment and innovation in technology, especially in green, low-carbon development technologies. This is detrimental not only to the global economy, but also to achieving our other goals.
Annetta, Karen and I are just debating the word negotiations. Don't you have negotiations before you take action, rather than taking action and then having negotiations?
Well, I guess that's semantics when it comes to the situation we are in. It could well be that there will be negotiations and then there's action after these negotiations. So clearly, just to bring you an idea about what Robert Habeck, the German economy minister, did there in China, because it was very unusual. Normally, German statesmen travel to China with a huge group of DAX CEOs and then please the Chinese and try to persuade them to their stance. So that's what we had in April when Chancellor Scholz traveled to China. No really open and frank words, but a lot of modest and also diplomacy. This time it was different. Robert Habeck traveled there with no kindness and no friendliness at all when meeting his Chinese counterparts. And he's saying that his travel to China has actually been very successful. Whether his open and very frank words prompted the Chinese to actually say, okay, we want to negotiate on these tariffs or talk about these looming tariffs remains to be seen. But at least when I read through the German press, it is perceived as Robert Habeck is bringing back a victory, at least a little bit of movement. Of course, it is hugely important for the German car industry, and the German car industry, again, is hugely important for the German economy, that we won't get a war of tariffs with China, because clearly China is still one of the biggest car markets for German suppliers and German car makers. For some, it's the biggest market. For some, it's the second biggest market, but it remains of utmost importance. So what Robert Habeck did is criticize the Chinese government for various issues. Russia and the increased trade with Russia. Chinese and Russian trade is up 40% last year compared to the year before. And that is, of course, a huge part on energy, but also the so-called dual-use goods, which can also be used for military means, are a huge component of that surge in trade volume. Then, of course, coal plants are on the agenda. So he criticized the government for not investing enough in renewable energies. And, of course, the car tariffs, because he clearly said, listen, if you don't want them, just show us that you don't unfairly subsidize your own car industries. And that is, I think, that what China now needs to do to prevent the EU to impose those tariffs.
Thank you. Thank you very much indeed for that, Annette. You've set out a lot of the key factors for us. So we'll carry on the conversation now with Holger Schmieding, who is chief economist at Berenberg. Holger, I'm told that we have two conversations with you. So the second one, we'll talk about politics in France and Europe. But on this one, we'll focus on Germany and in what is going on with its position regarding the EVs, the tariffs, and China as well. Holger, how do you see the situation?
Well, as we already heard, the German car industry needs China as a market. The German economy needs the car industry. So this is important. But what the visit of Habeck to China has apparently shown is that with China, you need to negotiate tough, because after all, China needs the European Union, including very much Germany, as a market even more than we need China. So we in Europe do have one of the biggest, the second biggest market in the world to offer, and access to our market should only be for those who play by the rules. And that's what Habeck apparently told the Chinese.
Holger, is it the same old problem with Europe? And we are low growth for a reason. In fact, we're low growth for many, many reasons. When I look at the higher growth areas and those that are producing products quicker to market, whether it be EVs, whether it be Karen's domain, AI, whether it be technology, whatever it may well be, that we are overpriced in terms of our labour costs, over-regulated. We have too much permitting problems. We don't have enough business-friendly policies, including getting capital to the right place in a timely fashion. Are we trying to penalise the Chinese because we're just not good at getting the product to market in the same way that they do, in the same way that other global regions do?
First of all, we definitely have many of the problems you mentioned over here, including getting capital fast into growth areas. But as to the Chinese issue, it indeed is to a significant an issue that China is wasting money by throwing too many subsidies at selected high-tech sector. They are buying market share successfully indeed, and that is partly at the expense of European, including very much German producers. But as we also see, the Chinese economy is rather sluggish. So China's attempt to buy market share works in terms of being competitive in some areas, but it does not work in terms of bringing the Chinese economy ahead. So if we list all the problems of Europe, we could also say the Chinese are actually suffering more from their approach to industrial policy by wasting money. They should, instead of having offered all these subsidies to producers, they should simply have let business getting on with finding the best market niches, not at the expense of huge subsidies and hence at the expense ultimately of what even in China does exist, the taxpayer.
Holger, just looking at an article from the South China Morning Post, and they're talking about how China has now overtaken Germany in many key exports, and just fleshing out the competitive threat about how competitive China is in the high-end space. What is the answer here? Because we know a lot of German CEOs have also been complaining about the landscape for the last 12 months plus. What is the answer? Is it from a German perspective, from a European perspective, that the issue needs to be addressed?
Well, the answer from a European perspective is, of course, to go against excessive subsidies if these are areas where China could indeed be highly disruptive for Europe, or if these are areas where China is sort of edging ahead in an unfair way. To some extent, we should just accept the Chinese subsidies and say, thank you, if we get solar panels cheap, that's okay. But on electric vehicles, we have to watch out that it's not too disruptive for too big an industry on the continent. That is part of what should be the European response. But in time-honored fashion, I think the major response by industry will be to simply shape up. After all, we've had many, many issues over the decades with European industry being facing heavy competition from abroad. And in almost all cases, European industry in the end shaped up or found different venues where it could excel. So I'm not too concerned about that. The real concerns in Europe are typically domestic policies, whether we are a good place for businesses to invest. That in Germany now includes, again, to some extent, labor costs. It very much includes over-regulation. The European response to this should largely be become more competitive. That is, look where you can deregulate. Look what you can do about unit labor costs. Look what you can do about your capital market. And anti-subsidy tariffs should only be kind of a last resort in specific circumstances.
Holger, just a quick one on the German economy and how it's tracking. We had some PMIs last week showing, again, further contraction in the manufacturing sector. Is there any clear evidence that Germany is emerging from an economic trough?
There is clear evidence that the German economy probably is expanding slightly at the moment, driven a bit by consumption rebound. But these PMI surveys do indeed signal that this is not much of an economic recovery yet. And they do signal that indeed in the manufacturing space, especially with export orders, German and European industry is facing more problems at the moment than expected. That is indeed signal that the economy will likely be driven almost exclusively by domestic demand, by the strong purchasing power of consumers, and that foreign demand is helping significantly less than we and others had expected, say, half a year ago. On the other hand, the foreign demand, the domestic demand story does not look too bad. So it probably still is an economic upswing, yes.
Holger, thank you very much for that. We're going to continue the conversation with you in just a bit around the French economy and the elections. Holger Schmieding with us, chief economist at Berenberg. Coming up on the show as well, just 1 week to go until the first round of French elections, with polls showing Marine Le Pen's National Party is in the lead. We'll look at what's driving sentiment. Plus, Europe's IPO market is set for its slowest year in a decade, according to FactSet. We'll discuss the broader outlook with our guest this hour. Also ahead, we'll get a reading on German business sentiment today. Don't miss our conversation with the IFO president, Clemens Fust. That interview is coming up at 10 a.m. CET.
Listen to CNBC's Beyond the Valley, the podcast that explores the biggest tech news from across the globe. Join me, Arjun Karpal.
And me, Tom Chitty, every week as we bring you insights into the top stories, unpack the latest trends, and find out where the industry is headed.
Now available on Spotify, Apple Music, and Google Podcasts.
And not a bad trading week for the US markets, for the Dow in particular, average for the S&P 500, but somewhat of a fade on the tech-heavy NASDAQ, where a lot of the action has been concentrated in recent months. But the Dow outperformance over the course of the trade Friday, slim gains to the upside, fourth positive session in a row, though, enough to encourage the market up almost 1.5% for the trading week, in contrast to the S&P 500, up about 0.6 for the week, with a slight red tilt in that Friday trade. And for the NASDAQ, it was a weaker finish for Friday, but also a fairly flat trading week for the index that has been leading the charge higher. So a little bit of a change in terms of leadership stateside. US tech, there was quite a week. We saw Nvidia claim the top spot in terms of market leadership and then fade in a give back trade on Thursday, but also on Friday, giving back further territory. 3.2% is what we saw in that trade as the stock gave back some territory and slipped from the top spot. The challenger, of course, being Microsoft, that saw further upside, up almost 1%. So Nvidia stock certainly in the spotlight, but not able to hold all of that attention, perhaps provoking some concerns about the rapid ascent that we've seen in the play that has been Nvidia around the AI story. But elsewhere, we've had other big names, very mixed picture, you've got to say. Apple stock trading down near on 1%. Amazon up 1.6%, so real split fortunes in the technology basket. I want to take you to the dollar. Japanese yen very much in focus for us today, with 159.75 on the back foot versus the Japanese yen. Lots of verbal intervention at this point. The top currency official, Masato Kanda, has effectively said they're prepared to intervene again in markets, so FX intervention front and centre for market participants at this stage. Elsewhere, we've got dollar off anyway, as sterling euro is trying to make gains morning session. So you can see euro dollar having a bit more success at this hour. Almost 107 is the trade there. To the Asian markets. The early picture is somewhat weaker across the board, from Australia to the Chinese markets. We are giving back about 0.75% on most of these market indices. The opposite effect for the Japanese stock market, that's climbed by that amount. So putting on some fairly modest ranges, 280 odd points to the upside for Tokyo stocks. And let's get to the opening calls for Europe and see how we're perched ahead of the session. We're looking at some red arrows this morning. So the early signals downbeat for the FTSE 100, the DAX, and also the French market, in contrast to Italian stocks that seem to be called higher. US futures, the early picture ahead of the trade today looks somewhat patchy, bit of a mixed picture, not a huge amount of direction at this stage, but you can see the Dow expected to give back just a little bit of territory. And markets will be out listening for a flurry of Fed speak this week, starting today, when our US colleagues will be speaking to the Chicago Fed President Austin Goolsbee. That is coming up at 14:30 CT.
It's just a week until the first round of the French elections. Latest polls suggest the far-right national rally led by Marine Le Pen is in the lead. Support for the party was pegged at 36% in a poll carried out by Elab over the weekend. In contrast, Ensemble Alliance, or the Ensemble Alliance, which includes the President Macron's Renaissance Party, is currently polling at 20%. Meanwhile, a separate Ipsos survey published in the Financial Times suggests the national rally is more trusted on economic issues than its main competitors. Holger, I've been looking through, Holger Schmieden rejoins us from Berenberg. Holger, looking through your copy on this one as well, and you say that a hung parliament remains the most likely outcome. Our viewers are absolutely fascinated on the ramifications of what's going in France for their equity, their bond, their broader investment positions as well. Are they right to be concerned?
Yes, they are right to be concerned. There are basically sort of two kinds of outcomes in France. The one is a hung parliament where the National Rally plays a major role, but where it would not really set all policies. That would likely mean that in France we see modest reform reversals because the far right and the far left do agree on some points. We would probably have, due to modest reform reversals, due to some noise in relations with Brussels, we would likely have less trend growth in France, somewhat elevated yield spread to stay, and France with a worse reputation globally being less of a magnet for foreign direct investment. Then there is the other outcome, where, for instance, the far right has a majority in parliament and pursues all of its previous agenda, which is a bit spendthrift, or where alternatively the ultra left or the united left, including the ultra left, is in charge and pursues its agenda, which is very spendthrift. If we have a parliament in France with a very spendthrift agenda, then we might have actually an immediate financial crisis, which would be quite a bad outcome. A financial crisis where in the end France would probably have to relent, but it could be a very noisy period. So either we have a bit of backtracking, or in a tail risk scenario, unlikely but not impossible, we might soon have a financial crisis in France if really this election yields to a government which pursues absolutely the opposite of the economically successful policies of Emmanuel Macron.
Holger, people have worried about far-right governments for a very long time, and yet, dare I say it, the experiment in Italy at the moment with Fratelli d'Italia and Giorgia Meloni is that actually her policies seem to be bolstering the Italian economy at the moment, and Italy is growing at a better clip than its northern European rivals.
Absolutely. And even before Meloni was elected, I sort of did no longer put her in the far right camp because she tacked very much to the center. She is in Europe pursuing the pro-EU, pro-Ukrainian, pro-NATO policies. She is domestically, in terms of fiscal policy, largely in line with European and Italian needs. So her policies are pretty much, you could say, kind of center-right, despite the label far-right that is still often attached to her. Marine Le Pen, at least judging by what we know about her and her past pronouncements, could likely be a bit more of the genuine radical sort. The kind of hope is that Le Pen, in order to not rock the boat, in order to be electable as president in 2027, that she actually will try to act like Meloni, and that, if so, would mean it's only kind of a modest setback for French trend growth. But I don't trust Le Pen as I trusted Meloni to pursue largely the right policies. Le Pen is much more likely to have a noisy relationship, for instance, with Brussels, which would not be good for France. She is much more likely to hand out a few social goodies here and there, whereas Meloni actually cut a few benefit spendings. So I would be positively surprised if Le Pen were indeed to do the full Meloni. She'll probably try to mimic Meloni to some extent, prevent a major crisis, but still have France impaired in the sense of less trend growth, higher yield spreads over Germany, and less inward investment.
Holger, just quickly, what should the priorities be for France? Because we know that the current fiscal spending has been an issue for markets lately. We know that the pension reform may fall by the wayside given some of the challenges we're seeing in the polling. What should the priorities be for any incoming government?
Well, the priorities should be to change policies as little as possible, because by and large, Macron has been on the right track. Even Macron is facing fiscal challenges, and judging by the programs of the far right and the United Left, these fiscal challenges will only get worse after this election.
Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to cnbc.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabile Kumete, weekdays on CNBC.